It's so exciting when a company presents you with an opportunity to build wealth over time through sound investing. Hey guys, welcome back to my channel where we dissect the most epic companies to see if they're worth adding to our portfolios. Today we're diving deep into Adobe ADBE stock. And this one is special because I am so confident in its future that I am buying 11 shares for our portfolio this week. But here's the catch. You have to earn it. We need to understand its price-to-earnings ratio, which simply put tells us how much investors are willing to pay for every dollar of profit a company generates. Let's go. Fair price for ADBE here. That's a clear breakdown of Adobe's annual price-to-earnings PE ratio from 2015 to 2025 based on historical data. You can see it clearly in this graph. In 2015, Adobe's PE ratio reached its peak of 73.15. This was during a significant transition period for the company, when it shifted from a perpetual software license model to a subscription-based Creative Cloud. While earnings per share didn't keep pace with the soaring stock price that year, the high PE reflected investor optimism about Adobe's growth potential in the cloud era. The ratio then steadily declined through 2022, bottoming out at 43.6 in 2020 as earnings eventually caught up with valuation. In 2025, the PE dropped again to 26.47, suggesting that Adobe's earnings growth has outpaced its stock price. This could indicate that the company is currently undervalued, or that the market is not fully appreciating its growth prospects. However, understanding this ratio alone isn't enough. You also need to know what a fair price-to-earnings multiple is for ADBE. To figure that out, let's look at Adobe's 5-year compound annual growth rate, or CAGR, for earnings per share. Here's the thing. If we consider the current EPs of $15.59 and compare it to what it was 5 years ago, we get a 17.25% 5-year compound annual growth rate, CAGR. Basically, this means that Adobe's earnings per share have been growing on average by 17.25% each year over the last 5 years. Now, to calculate the fair price using the price-to-earnings ratio, we need to find the average PE multiple that Adobe has had over the past 5 years. When we do that, it comes out to be 40. Multiplying the current EPs by this average PE ratio gives us a fair price of $700 for Adobe stock. So, the current price of $356.70 is well below the calculated fair value of $700. This difference suggests that Adobe stock may be undervalued and has the potential to rise to its fair value over time. But that's not the whole picture. Let's add another layer of analysis to this. Fair value estimate 5-year horizon. Here's the deal. Using the current EPs of 15.59 and projecting it forward for 5 years with a 17.25% compound annual growth rate, we arrive at an EPs of 34.55. Now let's run a buy and hold simulation with the same numbers. Adobe projected a return of 17.25% annually, compounded over 10 years. This means that after 10 years, your initial investment would grow to 11 shares worth nearly $39,622. So why is Adobe's stock price falling in 2025? Despite record revenue and strong earnings, Adobe's stock has dropped over 20% year-to-date and 36% over the past year. Here's what's driving the decline. 1. Disappointing revenue guidance. AI competition heating up? Recently, Google launched its Gemini app, which offers advanced image editing features that directly challenge Adobe's flagship product. This competition is worrying investors who fear that Adobe's creative moat is being eroded by free or cheaper AI-powered alternatives. This sentiment is causing some investors to sell their Adobe shares and seek opportunities in the AI space. 3. Valuation compression. Adobe's forward PE ratio has fallen to approximately 15.3, which is significantly lower than its historical average of 47.8. This compression reflects a broader cooldown in the tech sector and skepticism regarding premium multiples for companies like Adobe. Despite these challenges, Adobe's management seems confident and is taking steps to address these issues. For example, the company is pursuing aggressive buybacks, doubling down on AI initiatives, and messaging investors to reset expectations for the company's future growth. Now let's talk about what I think about all this. Adobe's projected fair value in 5 years is $1,382 per share. If you were to invest $4,000 today, It could grow to 11 shares worth $15,202 in 5 years. If you maintain that investment for an additional 5 years, your initial $4,000 investment could grow to $39,622. That's a potential compound annual growth rate of 25.77%. This makes Adobe a very attractive high-growth compounder. Additionally, the company's strong fundamentals and positive outlook suggest that there's still a lot of upside left. So what's not to like? Adobe looks poised for continued growth and success, making it a great investment opportunity. It definitely has my attention. However, I also want to highlight the importance of keeping an eye on certain factors that could signal trouble ahead. I'll call this section my checklist for catching Adobe's market share loss early.
1.
Slowing revenue growth versus peers. If Adobe's revenue growth starts lagging behind competitors such as Canva, Figma, or other AI-native platforms like Google Gemini, it could be a warning sign. For instance, in 2025, Adobe's guidance of $23.3 to $23.5 billion fell short of expectations, suggesting a potential slowdown. If this trend continues while rivals accelerate, it could indicate that Adobe is losing ground. 2. Flattening or declining ARR. Adobe's ARR is crucial for its Creative Cloud and Document Cloud businesses. If our growth slows or stalls, especially in AI-enhanced products like Firefly or Acrobat AI Assistant, it could signal that users aren't sticking around or upgrading. 3. User engagement metrics. Adobe often provides metrics on feature adoption. In 2025, the company reported that 35% of Photoshop users were actively using Firefly's generative AI tools. If that number plateaus or drops, it could suggest that users are exploring alternatives. 4. Pricing sensitivity and churn. We should watch out for increased complaints about subscription costs, rising churn rates in lower-tier plans, or slower net new subscriber growth. These signs indicate that Adobe's pricing model is becoming less appealing, particularly to freelancers and small teams. 5. Delayed monetization of AI. While Adobe has made strides with Firefly and Gen Studio, analysts are concerned that these tools aren't yet driving meaningful revenue. If Firefly remains primarily an engagement tool without a clear monetization strategy, and competitors offer faster payback models, they could win over Adobe users. 6. Competitor momentum. We need to track the progress of platforms like Google, Gemini, Microsoft Copilot in Office, Canva, Affinity, and open source tools. If these platforms gain traction among Adobe's core user base, designers, marketers, and educators, they pose a direct threat. If any of these indicators flash red, it's essential to investigate further. And if several points raise concerns, it might be time to reevaluate Adobe's position in our portfolios. If you found this analysis helpful, I would appreciate it if you could show your support by hitting the like button, sharing this video with someone who might find it valuable, and subscribing to the channel for more in-depth company breakdowns. Thanks for joining me today. Until next time, take care and good luck with your investing journey.